Greetings, fellow Rotarians and guests. My name is Joe Young, and it's my honor to serve as the 2020-2021 President of the Rotary Club of Columbus. Founded in 1915 with our first meeting in February of 1916, our club is one of the oldest and largest within Rotary International. Our membership includes a diverse set of leaders within business, city government, military affairs, healthcare, education, arts and culture, social services, and ministry, all sharing a common desire to improve our community and have a positive impact on the world around us. The world needs Rotary and the ideals that we represent now more than ever. The onset of the COVID-19 pandemic has dramatically changed the way we live, work, and interact with one another. School-aged children that were already struggling with food insecurity and educational development are falling further behind. Recent acts of violence perpetrated against our African American brothers and sisters have further highlighted the fact that systemic racism continues to plague our nation. Political division and social unrest continue unabated. The world needs our leadership. And while these are extremely difficult challenges to overcome, Rotary is well positioned to be part of the solution. On behalf of my wife Vicki and our daughters Katie and Lynn, I want to thank you for all that you are doing to make our community a better place to live. It's my pleasure to serve alongside you. Now let's get to work. Greetings, Rotarians, and welcome to the January 13th meeting of the Rotary Club of Columbus. I appreciate your patience with us as we work to fix the audio and the video feed to Facebook. We're broadcasting live from the boardroom, the Columbus Trade and Convention Center. We're so glad for our partnership with them, for them to continue to host us through these challenging times. Want to call on grandchildren of past President Michael Silverstein with today's pledge.
One nation, under God, indivisible, with liberty and justice for all.
Thank you so much, guys. That was great. Appreciate you sharing the pledge with us. It's our tradition as a club to recognize a soldier each week from Fort Benning, and often we have active duty soldiers join us when we're having lunch meetings. Sometimes we'll do videos of them, and every once in a while we have an opportunity to honor one of our own. We're happy to do that today, and it's my pleasure to call on Dick Nurnberg with today's introduction.
President Joe, fellow Rotarians, our military member for today is Colonel Retired Mike Burns. Mike served over 26 years in the Army as an infantry officer, culminating in the job as G3, Director of Operations and Training at Fort Benning. Before that, he was a Deputy Commander of the Battle Lab of the Base Brigade, and he also commanded the 247 Infantry Battalion at Fort Benning. He graduated from Norwich University in Northfield, Vermont, which is not that far from Bates College, in 1980. And after that, he entered the Army. He has 2 master's degrees, one from the Army War College and one from the U.S. Army Command and General Staff College. He currently serves as Special Assistant to the Commanding General at Fort Benning, and he has done that since 2011. And as such, he is the Commanding General's representative to the civilian community, which includes, among other things, our Rotary Club, the Chamber of Commerce, and various other duties, and is a very important job there. He's married to his wife, Kathy, who we all know has a better job than he does as special assistant to a state senator, or a U.S. senator, and she is from Beverly, Massachusetts, and they have 2 children. Mike, we thank you for your service, and we encourage you to keep going and keep helping us all out. Thank you.
Mike, thank you very much for your service to our country, to our community, and our club. We can't thank you enough. Clearly, you are a man that knows how to catch big fish, and so that's like a fun pastime, and hopefully you have plenty of opportunities to do that here in the future. It's now my pleasure to call on past President Michael Silverstein with introductions for our latest Paul Harris Fellow recipients.
Good afternoon, President Joe and fellow Rotarians. What a great way to start the new year of 2021 with the recognition of our newest plus Paul Harris Fellows. We as Rotarians understand and embrace the responsibility to not only improve our community, but impact the world around us through our charitable contributions to the Rotary Foundation. In 1957, Rotary established the Paul Harris Fellow to encourage and show appreciation for an individual Rotarian's contribution to the Rotary Foundation. And for our newest members, in order to be recognized as a Paul Harris Fellow, requires a cumulative contribution of $1,000 to the foundation. And for each additional $1,000 that you contribute, you're then recognized as a plus Paul Harris Fellow. For anyone that is currently not a Paul Harris Fellow, the easiest way to start that commitment is by becoming a Paul Harris Sustainer, which simply means contributing $25 each quarter to the foundation. The $25 donation is added to your quarterly dues statement. In keeping with our club's ongoing commitment to the Rotary Foundation, it is my pleasure and honor to recognize our newest plus Paul Harris Fellows, Kaizad Shroff and Butch Barwick for becoming plus ones, President-elect Lori Arden for becoming a plus 2, Melody Trimble for becoming a plus 3, and Charlie Johnson, our club treasurer, for becoming a plus 4. On behalf of President Joe, our board, and our entire membership, I congratulate each one of you, and I want to thank you for your deep commitment to not only the Rotary Foundation, but your commitment to service above self. Thank you so much.
Kazad, Butch, Lori, Melody, and Charlie, we thank you so much, and thanks to everyone that continues to support the Rotary Foundation. If you're like me, you're still trying to process the events that happened at the Capitol last week, the events that are ongoing at the Capitol even as we speak. I mentioned to the board, and it made me think of a quote that's attributed by Winston Churchill, that democracy is the worst form of government except for all the others. I know democracy is a messy yet beautiful ideal, and I'm so grateful that we have an opportunity to live in a country that's willing to put up with the mess in order to pursue the ideal. Our board had a special called meeting this week to discuss ongoing pandemic, sort of hospital statistics here in Columbus. And after discussion with representative from the West Central Georgia Department of Public Health, we've decided to suspend in-person lunch meetings for the rest of January. We're trying to do that just out of an abundance of caution. We want to be good stewards within the community. We feel good about our safety protocols that we've implemented for the meetings, but we're just, until the burden on our healthcare community is reduced, we feel it's most prudent to suspend lunch gatherings. So we'll continue to meet virtually. We're so excited to have this technology that allows us to continue to meet even though we are physically separated from each other. In light of the inauguration ceremony scheduled for next Wednesday, January the 20th, and our speaker is Mayor Skip Henderson, we're going to move the live broadcast of next week's meeting to Tuesday. It will also be at 12:15 on Tuesday, January the 19th. It's our goal to have the recording of the broadcast up on the Facebook page by next Wednesday at noon. So for those of you that have carved out that spot in your calendar specifically to join the Rotary meeting, hopefully you'll still be able to do so at the regular time frame if that's your desire. Since the club will be meeting virtually for the rest of January in light of the ongoing health pandemic, we wanted to see what we could do as a gesture of goodwill in the community to support our healthcare workers. And so what we've decided to do as a club, the board discussed this week, we're going to use the money that would have been used to provide lunch here at the Trade Center to instead have the Trade Center provide boxed lunches
to members of our healthcare community. And so we figure we can provide about 90 meals per week. And so we've reached out to our hospitals, and we're working on the logistics of that. For those of you that wish to volunteer to be a part of that initiative, don't know exactly what that will look like just yet, please contact the office and to indicate your willingness to be involved. Also, there are volunteer opportunities. When we were talking with Dr. Asante Hills as representative of the health department, they are needing assistance with a number of different things related to the ongoing efforts for contact tracing, vaccinations. You don't have to, put shots in people's arms, but there are a number of other things that we can do to help alleviate some of the pressure on the healthcare community that they're facing right now. So for those of you that are interested in volunteering for those efforts, please also contact the office as well. There's a virtual happy hour Rotary mix. It's going to be taking place tomorrow from 6 to 8 p.m. A link will be sent out from the office in a separate email. So I hope that many of you will be able to join for that. It's now my pleasure to call on past President George Flowers to introduce today's program.
Thank you, President Joe. Good afternoon, fellow Rotarians. I am pleased and honored to introduce Tom Martin as today's speaker. Tom is a senior portfolio manager and member of the Investment Policy Committee of GLOBALT Investments, an SEC registered investment advisor and part of the Synovus Financial family of companies. Tom joined the firm in 2014 with a vast investment management background, having worked as an investment officer for the Jen Spring Family Office, advising high net worth multi-generational families on investment policy, asset allocation, manager selection, and equity selection for over $600 million in assets under management. He was CIO for the hedge fund unit of Myritt Corporation, focusing on long-short energy trading, and was a global partner at Invesco Capital Management, where he was the lead portfolio manager of the core equity strategy for large institutional clients. He has been an active money manager in business since 1984. That's 36 years if you're counting. Tom received an AB in economics at Duke University. He is a chartered financial analyst and a member of the Institute of CFAs, for which he's a past member of the Council of Examiners. He is also a member of the CFA Society of Atlanta, where he served as president in 2001. In his spare time, Tom has been a volunteer for the United States Agency for International Development, working on capital markets education projects in Eastern European countries. He is currently a member of the Holy Innocents Episcopal School Investment Committee, and one of Tom's passions is hiking. He is headed for a 20-mile trek in the Great Smoky Mountains this weekend. Tom last spoke to our club in January of 2018. A whole lot has happened in the world since that time. He brings an experienced perspective to the economy and the markets, which we look forward to hearing about today. Welcome to you, Tom.
Well, George, thank you very much for the kind introduction. I appreciate that. I just want to confirm that I can be heard.
Yes.
Excellent. Okay. Well, thank you, Joe, for moderating, and for Ryan for running the technology side of things. I'll try not to mess that part up. Certainly on behalf of GLOBALT Investments, we appreciate the opportunity to share our thoughts on the outlook for 2021 and the markets with you today. I expect that I'm going to have about 20 to 25 minutes of prepared remarks, and then I will be happy to answer questions for as long as people want to ask them and as long as we're allowed to go on. So today we are, I need to share my screen. I already messed up. Here we go. Let's share screen. Okay, I presume I'm sharing my screen now, and that you can see that we have a presentation up called Market Outlook 2021, Survive and Thrive. Are we good, Joe?
Yes, you might want to put it on the full screen mode like we went through earlier.
Like we went through earlier, Joe says. Okay. There we go.
Great.
So I think I should be all set. So today we're going to put the markets in perspective from two standpoints. First is where we are today. So that's the short term, if you will. And the second is how things are likely to look closer to the end of 2021. And we'll call that the longer term for now and maybe take a little bit of a look beyond that. No one needs to be told that the markets are acting very strongly in the last year and even so far this year. Most equity markets are at all-time highs. Credit spreads are low. Interest rates are low, but they're nudging up. The markets are suggesting that we are going to survive and thrive. The quick synopsis is this. If you start by looking out to where we will be near the end of 2021, we think it will be a year of re-emergence and increased visibility. So I have a number of points in summary. First of all, the composition of the US government is set. The Democratic Party will lead the agenda, but they're going to have to moderate that agenda. And that's going to be interesting to see that get through. By mid-year, we expect to have some clarity on what that agenda is and the likelihood of its passage after there's some back and forth. Number two, we will have round-tripped a year on the pandemic. Vaccines will have gained traction by that point, and reopening on a sustainable basis will be underway, and we should have some visibility on that. The longer-term impact on various companies and industries, say from the aerospace or the travel industry to cloud computing and productivity, will really start to emerge. We will end up with very large fiscal stimulus, very large monetary policy and stimulus, and we'll have huge debts. That debt is going to be difficult, if not impossible, to repay from traditional economic growth. And that will foster talk about this thing called modern monetary theory, or MMT. Another code phrase for that is, quote, coordinated monetary and fiscal policy. Where we left off in 2020, the market was at some extreme levels. And that's the beginning and the starting place for 2021. So now let's look at a few details. COVID-19, we start and pretty much end there. I think there's no chart that does justice to what is happening in the world with COVID-19. The cases, the hospitalizations, the lockdowns, the strain on our medical resources, the pain and suffering of those who are really seriously afflicted with it, and the time that it takes them to recover. There's now a new, more infectious strain that started in the UK, but it's probably throughout the world. The UK is on its third lockdown, and they're saying through the middle of February. Germany is in lockdown through the end of this month, but they're looking at maybe mid-April. France is mid-February. Europe as a whole has 30% of the global cases and deaths, but they only have 1/10 of the population. So things are pretty bad in Europe. And you can see from this chart that they're pretty bad in the United States as well. Japan is increasing its lockdown. And just as an anecdotal matter, Malaysia instituted a national state of emergency through August of this year. National state of emergency through August. So the vaccine rollout is proceeding, but it's tough. It's lumpy. There's logistical issues, distribution issues. There's political decisions that need to be made, such as, do you use up the vaccines that were going to go for the second dose to more people to get a first dose and hope that you still will get some in time for the second dose? Things like that, pretty important. Interestingly, healthcare workers' acceptance stands at somewhere around 50%. And these are the people who are maybe second most in need after the very old or the very sick. There are frontline workers. And they are opting in at 50%, not because they think that vaccines are bad in general, but because they just want to see a little bit more time go by. So that's interesting, and we'll see how it turns out. What's happening with the economy? So the chart on this page shows GDP growth, and the impact has been huge in 2020. We went from pretty decent growth in 2017, 18, 19 to a negative number in the first quarter, -5%, a negative annualized number in the second quarter, which was astounding, -31%. We got a recovery from that quarter to the next, but it looks like for the full year, we're probably going to be down in the 3.5% GDP range. That seems like a small number, but it's pretty big. What's not on this page is what's happening with S&P 500 year-over-year EPS growth. And after having a couple of very good years in 2017 and 18 and a slowdown in 2019, but still positive, we had quarterly declines in earnings growth for the S&P of 15% in the first quarter, almost 32% in the second quarter, almost 10% in the third quarter, and it looks like the full year is going to be down about 15.5%. Now, analysts are currently expecting a big rebound in 2021, about a 22% year-over-year gain. That includes about a 15.5% growth in the first quarter of this year and 45% growth in the second quarter of this year. But that does not really take into account what we've been experiencing with the lockdowns and the spread of the virus. Just yesterday, analysts started cutting their GDP estimates for Europe for the first quarter of 2021. Those estimates were for positive growth in the quarter, and now they're for negative growth. We in the United States, we're going to get retail sales on Friday. We're expecting the third consecutive decline. So we're certainly not out of the woods yet with regard to the effect on the economy. Longer term, the issue is going to be employment. And this chart shows how long it takes to get back to to the employment you used to have before the recession took place. And that green line, that's the really long one, that's the most recent period that we have been through. That's about 8 years. So it could take quite a long time for us to get back. And of course, this time is different from the last time. There's a lot of changes going on in the economy, as we all know and experience, with business meetings and travel, entertainment, dining, hotels, restaurants, airlines. Just everything has potentially changed. It's everything from home versus we used to go out and do that. And so the level of permanent unemployment and getting those people reemployed might take longer even than it did the last time. We just really don't know. So in the face of that, we have had a lot of stimulus that we know, and this chart puts that in perspective. So there's two kinds. We call it the twin stimulus. One is monetary and one is fiscal. One is by the Fed, one is by the government essentially borrowing money and getting it into the economy. But if you look at the bottom line there where it says total, the central bank liquidity injection around the world has been about 14.5%. And the fiscal stimulus has been about 18%. That doesn't include new stimulus from the UK and considered stimulus elsewhere, including the United States. If you add those up, you're at almost 33% of GDP. And as we said, for the full year of 2020, we only expect a 5% decline. Now, they're not strictly comparable, but basically that's 6 times the stimulus versus the decline we've had. Of course, another way to look at it is that despite all this stimulus, we still had a decline in the economy. So think about how much worse it could have been. But there are some long-term implications for what happens. And some of that is going to get a little bit of visibility with the Biden plan, which will be released on Thursday for additional stimulus. But they are going to impact the deficit. They are going to impact the US dollar. They are going to impact inflation and interest rates, and then via that path, what happens in equities. So before we move on to some of those issues, I thought that people would be interested in seeing a chart about the presidential cycle in light of the election. I decided to add this one. This is for the S&P 500 average returns from the period 1981 to 2019, so almost 40 years for a re-elected president, which we don't have, versus a new president, which we do have. So the blue ones are the re-elected president, and what has happened, it seems, is that the markets had good returns, and then they sort of faded when you had a re-elected president. Whereas with the new president, the returns are lesser in the first couple of years, as they are maybe enacting some unpopular parts of an agenda, followed by growth in the last 2 years, maybe not so much not on purpose, so that the economy is good when it goes time to being reelected. I think these are interesting numbers to look at, and they give you sort of a framework, but think of it that things have changed a lot this time around, and we're enacting a great deal of stimulus on top of stimulus right from the outset. So it's really, and we have had great returns over the last several years. So the point is that this could go either way, and things are different. It makes sense to evaluate what's going on in terms of the information that comes in. One of the most important things is this next chart, which is the dollar. But before I get to that, I want to address interest rates. And the chart for that didn't make it into my chart pack, but I think everybody knows that the 10-year Treasury yield peaked in about 1982 at somewhere in the 15% area, and has been on a pretty steady march downward. And as a result of the pandemic, in March of this year, in April, it got down to as low as 0.36 basis points. So that's quite a decline. And it broke through the 1.5, 1.3 area because of this pandemic. It's been kind of floating around in that area, lately more in the 0.8 to 0.95 area, but it hadn't broken back up above 1 until recently. And now it got up to about almost 1.2% and is now trading at around 1.09%. So there are a lot of questions about what is driving this increase in the interest rates, whether it's a mini taper tantrum or Fed comments that have happened of late. But getting to the dollar, as you can see, has declined by a lot since the pandemic. And the market positioning in the dollar has been pretty much short the whole year, meaning that people think the dollar is going to go down. And it's almost been universally accepted by the end of this year that the dollar was going to decline. Oftentimes when something is universally accepted, it ends up not happening. But why has the dollar been under pressure, and why do people think that it's going to continue to be? Well, because of the amount of stimulus that the U.S. has put in place, the debt that has required, the slowdown in our growth, our experience with COVID versus the rest of the world, and then it will have an impact based on inflation and Fed tapering. All of those things have sort of come into question over the last several days, and you've seen the dollar recover a little bit. So each of those items that I mentioned are going to be very important in the effect on both interest rates and on the US dollar. So let's address inflation for a second. This chart looks a little bit difficult to understand, but the point is simply that the expected outcome for inflation has gotten to be much wider. In other words, there's a lot more possible outcomes for what could happen with inflation than there were back as early as late late 2019, when everything was sort of hunky-dory. If you look at that orange line, it shows the distribution of inflation expectations, and the expectation of deflation was almost non-existent at 7%, and the tails of that distribution were very narrow. It was basically all around 2% or so inflation, very high probability. At the middle of last year, when we had a good bit of what was happening and the effect on the economy, you saw that the odds widened out a lot for a lot of different outcomes for inflation, and that the potential for deflation, which is very bad, increased to 55% at that time, and the tails got fatter, meaning that you could have you had higher probabilities of higher inflation in the 6 to 8 to even 10% range, and of some pretty bad deflation in the -6 to -8% range. So this is important for what happens to inflation will definitely impact what happens with the dollar and with interest rates. So there's actual inflation and there's inflation expectations. And this chart here shows inflation expectations. It's rather busy, but if you look at the bottom, you can see where we were in January of 2020, what happened when the pandemic initially hit, and how those things have come back up. So expectations for deflation increased, or small inflation, and then we got back to sort of a more normal area. But what you're seeing, and when people are reading the tea leaves, they read very subtle influences. You can see that all three of those lines have really started to perk up back above the levels experienced at the end of 2020. Now, they're not alarming, but they are sort of the indicators of the beginnings of inflation. And it has been getting in the press. It has garnered some notice. But just as a anecdotal example, Asian container rates. So that's the stuff that they put in the containers on the big boats, and they send them from Shanghai over to the United States, and those have a rate. All that stuff that we're ordering online from our couches for our live at home, stay at home, work at home lifestyles that we've changed to, that's gone up by, the price of that container has gone up by 150% year over year as of December. Anecdotal, sure, but you can see how the effect of the pandemic has influenced that. Nonetheless, we did have a CPI report this morning, and everything's okay. You'll be glad to know it's fairly tame, still in the 1.4 to 1.6 area for core and for headline CPI. So right now, we don't have a giant read on inflation one way or the other, but we do have people watching it very closely. So I said that 2020 would be the starting point for where we are in 2021. And one of the most, there are a lot of extremes that we ended 2020 with and that we're starting this year with. The first has been the change in returns for equity styles pretty much throughout the world, but very much dramatic here in the United States. All the way on the left-hand side, you have the Russell Top 200 Growth. That's large capitalization growth companies. And all the way on the right, you have the Russell 2000 Value. That's small capitalization value. I won't make you do the back and forth yourself, but the spread between those two has been pronounced and huge and unprecedented for the last 4 years. In 2017, which is not on this page, it was 22%, the spread between growth outperforming value. In 2018, it was 13%. In 2019, it was 14%. In 2020, it closed out the year at 35%, but it was 48% for just the year to date in 2020 in August of last year. So it's been quite an extreme favoring those growth type companies. Those you might say are the not reopening companies versus the reopening companies. Why were those companies favored? Stimulus, low rates, low inflation, work, play, learn, everything from home, productivity, cloud, computing, software. The fundamentals all supported that. So what happens if those things change? Well, what you can see is what it did do is that it made valuation go to an extreme. So the NASDAQ 100 is your growth companies, They're the growthy ones, and they already had high PEs, and they went from high to a lot higher. You can see it just sort of spiked relative to prior years. So the movement in the stock prices moved the valuations to an extreme. But there's other extremes as well. Margin debt, people borrowing to invest in the stock market, is at or near highs. Bullish sentiment is at or near highs. The ratio of stocks to GDP is very high. Volume on the NASDAQ stock exchange is very high relative to volume on the New York Stock Exchange. It is a speculative market. IPOs have come to market, and if I'm flipping to the next page, notwithstanding all these extremes, when we look at our bull market top checklist, which you can see everything was checked in the year 2000 and the year 2007. So these really were indicators. I think that probably we all would have expected that they would be pretty much all checked right now, but they're not. The only one is this IPO activity, which I was about to mention, is checked. And you can argue about the finer points of some of these, but the point is that we really haven't seen some of these excesses, although we've seen some other excesses. So there's mixed messages here. And I think the message is that there is risk both to the upside and both to the downside. So it's not giving you a signal that you should just get out of the market and hide, but it's not giving you the signal that you should be complacent and have more exposure than you really can stand for your investment objectives. This next chart is showing what has been happening with this extreme of growth to value. And when the line is going down, that means growth is outperforming value. And when the line is going up, it means that value is outperforming growth. The title says that that rotation from growth to value has not been sustained. And certainly for the first 3 quarters of 2020, that was the case. And it's hard to say what sustained means. Is it just a month? Is it 3 months? Is it 2 years? Certainly you want to be on the right side of it if it is longer than certainly 6 months or so. And we're starting to see that is sustained, but it's sort of topping off here. So again, there is reason for growth to outperform, and there's reason for value to outperform. For example, if inflation stays low and interest rates stay low and the dollar stays low or weaker, growth will definitely be favored. When those things start to change, if they don't change so dramatically, maybe both will do well, or maybe both will go down. If those things change dramatically and we have a dramatic reopening, then you might have a case for value over growth. So to conclude, how do we put that in perspective for the portfolios that we manage? This is sort of a put your money where your mouth is. We believe that, first of all, there's high uncertainty and that the asset class prices are near extremes, that the fundamentals are supportive of this positioning for now, but there are changes that could make that change dramatically. So you see a lot of words here like under, over, under, different weightings from the market, but they're small. What we believe is that a portfolio, if you really are not sure which way things could go, you should probably be positioned closer to your long-term investment objective. So while we are underweight total equities, it's not by very much. We're pretty close to the markets. And while we're overweight U.S. equities, it's not by very much, but we do certainly favor them relative to international markets. And we certainly favor mid-cap and small cap at this point to some small degree versus the large cap companies. We're underweight the developed international markets and a little bit on emerging markets. We are underweight bonds, but our duration is neutral, so we have exposure to fixed income. Where is some of that underweight money? It is in gold, which is a hedge potentially against inflation potentially against the devaluation of currencies in general. And we do have an overweight position in cash, which we will use opportunistically if the opportunity presents itself. So with that, Joe, I think I've taken my 25 minutes, and I will turn it over to you guys for questions and answers.
All right. If you'll turn off your screen sharing, and then we'll bring in Cameron to field questions for us.
I have turned off my screen sharing.
Hey, Tom.
Hey, Cameron.
Great to see you. Great to hear from you. It's an encouraging outlook and wonderful way to start 2021 with some positive attitude and positive spirit about what we have in store. It continues to be an uncertain time, and I think many people like me have been, I don't know, somewhat perplexed, astounded, but pleased with the market's ability to remain strong in such unusual and uncertain times. And we appreciate your presentation today and joining us. I have a few questions from some of the members, pretty specific questions. The first is, do you anticipate means testing for persons who qualify for Social Security benefits?
Well, gosh, I didn't expect that one. So the answer is, I guess I hope not, because someday soon I'll be requesting Social Security benefits. And I hope that that I get what I put into the system. I think that question goes to the larger question of what will we do to reduce all of the debt that's outstanding if it cannot be met through economic growth? And will there be some degree of austerity measures that will be considered, at least, if not put in place? And I would think that that would be one of them. Means testing has been floated before, back when debt levels were high relative to the past and nowhere near as high as they are now. So I think that it's realistic to expect that that will come up. And it's a very open question to see how that will actually flow through, especially given the composition of the government right now, and some of the ideas that are further to the left side of where the party is probably going to have to sit, as you have even though you have all Congress and the presidency in one political party, it's pretty darn close in Congress. So I think you're going to have to see a lot of negotiations and movement back towards the middle, which probably would not include means testing. So a long way of getting to the answer to that question.
Well, thank you. Eric Spears stated U.S. exports should be less expensive with the decline in the U.S. dollar. How do you foresee exports performing in 2021?
There's a lag effect, and so we would expect that U.S. companies should do fairly well in that regard. I guess the real question is, does the dollar have a sustainable increase, and will there be more of a perception of how that impacts things rather than the lagged effect of that? I hate to sound like I'm repeating the same answer, which is that is something that we just don't know. We are watching companies very carefully for how they perform, and the S&P 500 has a fair amount of companies that have a large exposure to international markets. The value of the dollar certainly will have an impact on that, but the level of stimulus, the level of interest rates, and what happens with the COVID and the lockdowns for now, we think will outweigh that for consideration, at least for most of 2020.
Right. Well, here's a kind of a general question. Dick Nirenberg's interested in whether or not you have any comments or thoughts about Bitcoin.
Well, thank you. Finally, a softball question. I appreciate that one. So I said that a little bit with a little bit of snark in it, but Bitcoin obviously has had some attention over the years, and the last time that it had even approaching this much attention was a couple of years ago, back in 2018 when it last hit its high, and then it kind of crumbled and collapsed. And I know because I owned a little bit of it through a Bitcoin trust, just a small amount in my personal account to help me kind of pay attention to it, as I think probably maybe a lot of people did. But I watched it go from 18 down to 5, and that was a really unpleasant experience. I think it's important to know that Bitcoin is very difficult to understand what it is anyway, what it means, and it pays to not lose sight of that, especially when thinking about where it might go or what you do with your money with that regard. What's different this time is the attention it's gotten is from institutional investors, and it's gotten a certain amount of legitimacy. Is it a currency? Not really. Is it a store of value? Not really. Is it something that people believe in as a substitute or a proxy for some of those things? Yes. Is its price being bid up by speculation? Absolutely. Is its price being bid up by some very real things? We talked about devaluation of fiat currencies. So yes, the dollar has declined versus currencies, but do all currencies decline versus some other thing like oil or gold or Bitcoin, for example? And the relationships among these types of assets are changing. There is a finite supply of Bitcoin, but Bitcoin can, to some degree, be done in by the authorities. So if central banks or governments decide that they're going to make it so that Bitcoin really doesn't work or isn't usable in a larger environment rather than just a fringe environment, the value of it could decline dramatically. We at GLOBALT are taking it seriously. We have done a lot of work on it, considering it as an asset class, and to understand as best we can what it is and what it isn't, and whether or not we want to include it in our portfolios. We think we have some degree of cover because other large institutions and so-called, sophisticated and smart money has been doing just that. We also recognize that that doesn't really mean anything. Everybody can get sucked in. So all that to be said is that it's worth watching. It could go a lot higher. It could go all the way to zero. And so if a person was thinking of playing it by watching it, don't put more in it than you can afford to lose altogether.
All right. Well, thank you. We're at 1:05. There's one more question, then I'm going to turn it over to President Joe he can ask his question. But the final question is: can you comment on how the national debt will affect our economy over the next 5 to 10 years?
Yes. So the national debt is just it's 4 times or 8 times or whatever. It's huge relative to any measure of the past, and that debt has to be serviced through the interest costs on it. And so to the degree that rates rise substantially, that cost goes up substantially. So one impact that has is the fear of that, but it also is a reason why rates may need to be kept low. It certainly will be on the Federal Reserve's mind, I think, as they are looking at, how to influence interest rates in the economy. That debt does crowd out other kinds of spending, and so it is a what you would call a secular long-term headwind on growth while it's there. In other words, if you had no debt and you wanted to grow faster, you could borrow money and invest it or spend it, and you could sort of juice whatever activity you're trying to do. When you already have a lot of debt, it becomes harder to borrow that money and to juice your spending or your growth as a result of that. So the impact for sure is a headwind on growth, and then the problem of what happens if interest rates rise. And then the third thing, which we touched on, which is called modern monetary theory, where debts are forgiven or are monetized by printing, so-called printing of money. So when you have a government that is in charge of its own currency, and they issue debt, and people happily buy that debt with real money, they get that money, and then that debt is somehow or another forgiven or bought by the central bank with dollars that heretofore were not in existence. Nobody really knows what happens when that goes on for a longer period of time. And I think that's the biggest unknown. We said we'd take a look out past 2021, but that question is the one that's the biggest unknown. As a preview, it hasn't ended well ever in history in the past. And that's not a very pleasant thing to say, even though we're fairly positive on a number of things here. So that's sort of the sword of Damocles that we will be dealing with, and why you get questions like, how can we reduce the debt in a normal way without going about that? So excellent question. Thanks for saving that for last.
Yeah, it's always great to end on a real positive, so that's good. No, thank you, Tom, very much for your time. And President Joe, I'll turn it back over to you. Thank you so much.
All right. Thank you so much, Cam. Tom, thank you so much for sharing your remarks and your expertise with us today. We're so happy to have you on the Synovus team, where we both work, and glad that you're willing to share with the Rotary Club. It's our custom to donate a children's book to the Columbus Public Library on behalf of our speakers. So we're happy to donate a book that'll be inscribed in your name. So thanks again for joining us. For the folks listening in on the live call, just want to remind you that a replay of this broadcast will be available on Facebook shortly after the live broadcast concludes, and a link for a YouTube broadcast will be sent out from the office. A reminder, we've got a virtual Rotary Mix tomorrow from 6 to 8. So hope you guys can join us for that. Next week, the live broadcast is going to take place on Tuesday instead of Wednesday, where we'll have Mayor Skip Henderson speak to us about sort of the state of the city of Columbus and share his vision for the year ahead. So I hope that all of you guys will join us back for that. I hope that you will continue to love on each other, continue to wear your mask, take care of each other, encourage one another. We look forward to having you back next week. Let's get to work.